Welcome investors, and thanks for joining us on your Investment Advisor channel, where we decipher the markets so you can make actionable investment steps. I'm Jake Ackerman. Fed Powell says inflation is still way too high and to expect more rate hikes coming later this year. Energy prices, interest rates fall, and despite the call for a new bull market, we experienced the second worst week of the entire trading year. So let's take a deep dive and see what's going on. Fed Powell expects more Fed rate hikes ahead of inflation as inflation fight has a long way to go. Let's move on to this Reuters article here. The majority of Fed officials who see the central banks approving at least 2 more quarter-point rate hikes in the 4 Fed meetings left during the 2023 year. But is that really the case? And the Fed has all along told us that they're going to be data dependent. Data dependency, whether they're going to hike rates, whether they're going to pause rates, whether they're going to cut rates. So why are they getting so far ahead despite inflation coming down? I mean, we've seen the inflation data telling us that inflation is coming down. I'll bet it's not coming down very fast, but nothing usually goes down very fast one way or the other unless we're in some kind of serious situation, geopolitical black swan event, something like that, and then we can see asset prices, rates, or some kind of value moving fast. But generally, things come down slow. It's progression. And through 2021 and 2022, halfway through the year, I mean, inflation went up. It didn't just take off and shoot up to 6% overnight. It was a gradual process over the course of a 1.5-year time frame. So the unwind and decline of inflation is going to take some time. So why are the Fed officials telling us? Let me tell you what I'm thinking on this is the Fed doesn't necessarily want to continue raising interest rates. I mean, that puts immense pressure on the economy. It strangles jobs, keeps monetary policy tight, which makes getting money, getting funds for your businesses, funding the economy, it makes it difficult. It puts immense pressure. So the Fed doesn't necessarily want to do that. But what do they want to do? They want to talk tough. They want to talk hawkish. And that, by doing so, keeps monetary policy tight without them actually having to do that, to minimize job losses, to still allow credit to get into our economic system, to the economy. So they don't necessarily want to strangle it if they don't have to, so they're going to talk. Expect them to continue to talk tough, even if they're not necessarily going to raise rates. But if we start seeing inflation tick up, we start seeing CPI, that consumer price index, PCE, personal consumer expenditures, housing, if job numbers go down, I mean, if the job losses don't go up as high as they expect, means the job market remains extremely tight with inflation going up, then they're probably going to raise interest rates. You know, the stock market's been really rising very quickly over these last month, and I don't think the Fed wants to see that take place. If the stock market goes up, that means people are wealthier. They can spend more money. That thereby spending more money creates inflation. They can spend more money in their businesses. That's generally what psychologically happens. So let's take a quick look into one of the markets. Right here I have the 30-year fixed mortgage rates, which is tied to the interest rates, which is tied to the Fed's funds rate, which is controlled by the Fed. And it really, as you can see from that line there, it really hasn't went anywhere. It's actually came down this week. So the Fed's telling us, hey, you investors, people working, we're going to raise rates because inflation's too high, even though it's coming down. But the market says, I don't know. We're going to still come down because we don't necessarily believe you, and because we see inflation data coming down right now. Now, again, we'll see where the data lies, but the Fed's been telling us they're going to be data dependent, and so far they have been. The inflation's coming down. What did they do last meeting? They paused to wait and see, which is exactly what you would expect them to do. Let's take a look at another little data point here. Crude oil. Crude oil has been trending down. That is the ramifications of crude oil prices coming down cheaper goods, cheaper food, transportation costs, manufacturing, which has tons of petroleum products in it, are coming down. We've seen it continuing to come down, thereby bringing down inflation. So the Fed doesn't necessarily have to do it, but I would continue to not, we got to take them at face value, but not necessarily understand what they're trying to do psychologically to consumers and businesses. If they're telling us they're going to raise rates, businesses and people that are going to buy houses, I might wait and see, which is what they want. They want the economy to slow down, to flatline, to decline. They don't necessarily want to see massive job losses, but they want some job losses. There's too much excess. So continuing to see the right trend. Well, let's pop into next week. Let's see what lies ahead of us. We have some PCE data, some personal consumer expenditures. That's going to be next Friday on at 8:30. So expect that. That's going to be another big data point, and that could point to the direction of, hey, they might actually raise rates in July. If we get as expected, lower than expected, probably not going to raise rates. Let's see how the next couple months play out. One data point doesn't dictate one way or the other. I've said this over and over again, no markets go in a straight line. So it might have a slight uptick. Long as it's at expectations, I think we'll be all right. We start shooting way above expectation, then we have a whole nother dynamic on our hands, and we'll have to see. Quick look at what happened in the market this week. I told you about the worst week we've seen and the second worst trading week of the year, down 1.76%. Is that a cause for concern? We've been told we're in a new bull market. What is going on? Folks, seasonality. Prices shot up big in the month of June. Almost a blow-off top rally. That's a trader's term referred to as huge price increase or a big price decline. That's a major sell-off. So we got a blow-off top in this particular scenario potentially. So when prices go up too far, too fast, we see the opposite take place. We start to see a pullback. That's what it's called, a pullback, a sell-off in the market. That's completely fine. And we're coming into seasonality. Investors, traders are on vacation in the summer. Summer's generally slower. Consolidation of prices, especially when prices went up so much. So nothing out of the ordinary, nothing to panic. But here's the deal. We still haven't seen the full ramifications of this tight monetary policy. We're not going to feel that probably for quite some time, the real ramifications. The things are going to happen slowly. We might see these job losses, jobless claims tick up, and we've already started to see the first phase of that. So I would expect that to continue. The job market has remained extremely resilient right now, but we'll see going forward because they're going to keep rates tight, and that's going to still cause stress on the job market economy. And so we will see what we have going forward. So tune in next week, Friday, after the PCE data. We'll give you our insights, thoughts. If you got some value out of this, do us a favor, like and subscribe. And we'll join you next week. Expertise you deserve, experience you can count on. Jake Ackerman.